Hello, and thanks for joining us. My name is Perrin Desports, and I'm going to be your host for today's webinar. On behalf of my partners at Tusk and all the great people at Pelton and Crane, thanks so much for your time and effort in being here with us today. We're going to talk about exit strategy and selling your DSO. This is the fourth in a four-part webinar series where we've covered the foundational aspects of group dental practices and DSOs, how to start a DSO, how to grow a DSO, and now we're going to cover exit strategies. This will be an overview of the process, buyers, multiples, and deal structure. Tusk is the firm that specializes in industry-leading resources for the emerging DSO. We help our clients start, grow, and sell their group dental practice. My name is Perrin Desports. As I said before, I'm going to be your host for today's webinar. And I spent my 22 years in the dental business focused on the distribution, retail, and manufacturing side. I spent 7 years with a privately held distribution company out of Columbia, South Carolina called Thompson Dental Company until Patterson acquired that business in April of 2002. I was fortunate enough to be able to stay on board with Patterson for over 15 years. And in that time, I ran 3 different businesses for Patterson: Richmond, Virginia, Metro New York, New Jersey, and my last 7 years were in Charlotte, North Carolina. Over my 15 years with Patterson, I saw a lot, made a lot of friends, and learned a lot about the industry. And one of the developments late in my career with Patterson that we're all acutely familiar of at this point was the aspect of dental service organizations, or DSOs. For the longest time, the Heartland Dentals, Pacific Dentals, and Aspen Dentals of the world were really the ones that carried the banner for group dental practices. But in the last handful of years, we've seen quite a number of these, what we call emerging groups, or the emerging market DSO space. Think 2 to 25 locations, roughly speaking. That's the fastest moving segment of the space, and what we're going to focus on for our fourth webinar here today. I'm going to do a quick overview on dental industry consolidation with a present and future outlook behind it, just to reorient us to kind of where we find ourselves in today's world. We'll talk about what's happening in the dental economy very briefly and why DSOs and private equity are buying dental practices. There's a massive roll-up, obviously, that's going on in our space. Call it consolidation. That's driven primarily by student debt and the retirement of baby boomers. The trend began about a decade ago, and depending on who you talk to, the industry is anywhere from about 15 to 20% consolidated today. The largest sector of that growth in DSOs is doctor-founded groups. In short, the new face of corporate dentistry really is your local dentist. We estimate that there are well over 1,000 of these dentist-owned groups and DSOs in the marketplace, and they seemingly pop up, one every other day. So why are DSOs and private equity buying dental practices? Dental practices themselves are largely recession-proof. Whenever we talk about a down year for the practice of dentistry, it usually means flat revenues. But it typically doesn't mean the massive swings that we see in some other sectors of the economy. There are also economies of scale to be had the larger you get in these businesses. We talked in our prior webinar about consolidating costs and centralizing some infrastructure. The asset class, as it relates to dental practices, is also seen as a less risky investment than other healthcare verticals that we follow. And there's a lot of cash sitting on the sideline right now in private equity funds. In 2016, as a matter of fact, there was over $270 million in additional capital invested over the prior year, and 89% of funds actually hit their capital raising targets. That was an all-time high. I'll remind you that the typical goal of private equity groups is about a 3 times return over 5 to 7 years. That's 300% return on your money in 5 to 7 years' time. Probably better than what you're going to get in a checking account and slightly better than what you're going to get in the stock market. If we take a look at this slide, this is the top 10 DSOs by name that we all know and are familiar with. And what we've done is try to show some of that growth and the fact that we say that private equity's expectation is to triple their money in 5 to 7 years. We'll kind of illustrate that point through the growth in locations. So let's take a look at just Heartland Dental. They're the biggest kid on the block, top of the left-hand side here. And in 2011, Heartland Dental had about 300 locations. Fast forward 3 years to 2014, and they have 550. And in 2017, they closed out the year somewhere around 800 locations for a growth of 167% over that period of time. 9 of these top 10 DSOs are backed by private equity, the one exception being Pacific Dental, which is still privately held. But I think that when you look at some of the growth numbers on the right-hand side, you can see triple digits in many instances, and that kind of corroborates the point of private equity's goals of tripling their investment over some 5 to 7 years in time. As we look at the different segments of the dental space overall, it's worthy to note where we are and where the crystal ball sort of indicates that we're going to end up. This is a slide that was taken on different segments of the market in the year 2016. And you see that private practice, your solo dentist, solo location, makes up about 3/4 of the market, 75%. Your middle market groups of 2 to 25 locations make up about 13% of the market. And then your elite groups make up about 12% of the market. Elite groups are the ones we showed on the prior slide. Now, as we fast forward over the next 5 years' time, it's interesting to see how those numbers change. And this may be a little bit hard to read on the slide, but your private practice, single doctor, single location, drops from about 3/4 of the market to about 60% of the market. Your middle market groups go from about 13% of the market to about 25% of the market. And your elite groups go from about 12% of the market to somewhere in the middle teens, but strong double digits. That's the way the pie changes over time in terms of share. The really compelling aspect of this slide is the middle section that toward the bottom that says compounded annual growth rate, or CAGR. And what you see is that the middle market group is growing at about 12 to 15%. Your enterprise level or elite groups are growing at strong double digits, 10 to 12%, but your single doctor or solo location is only growing at about 1%. When you think about some of the statistics that you hear in financial news, Wall Street Journal, CNBC, some places like that, that talk about the GDP growth, gross domestic product growth, which is a measure of the national economy, being at about 2.5% to 2.7% at the end of 2017. We forecast the dental industry to be growing at about 6%. So the practice of dentistry, the business of dentistry, growing at 6% and GDP being about 2.5% to 2.7%. So dentistry is growing at about twice the rate of the economy overall. But when you look at these middle market group practices and enterprise level DSOs, they're growing at about twice the industry average and 4 to 5 times as fast as the national economy overall. That goes to show the amazing growth rates that some of these businesses are experiencing as they continue to grow and scale. So let's talk about what it looks like to take a business to market and actually sell it. We'll talk about timeframes and expectations of a marketed sale process. And we'll start with what you should expect when taking your business to market. The first thing to note is that a dental practice, a group practice that you've spent a lot of time, effort, and a lot of sweat and tears, honestly, building over some period of time, when it comes to selling it, it's an emotional roller coaster. You really shouldn't underestimate that aspect because it carries a heavy emotional toll with it. The process can typically take anywhere from 90 days on a very fast sale to 9 months or maybe more if a deal is reached. And selling a group practice or DSO is nothing like buying or selling a solo dental practice. For those of you who may have grown through acquisitions and you bought individual dental practices, you know the process can be relatively quick. I don't want to say simplistic, but it's a lot easier to get those deals done on a one-off basis. But to do the same for selling a group is a dramatically different proposition. There's the preparation phase to go to market, which could mean a slight pause to clean up any internal issues or get the business really ready for sale. There's the process of being in market to attract buyers, be it financial buyers like private equity companies or strategic buyers like established DSOs. There's a due diligence phase where detailed information and requests are constantly made from the buy side, and responses are heavily detailed in terms of answering those questions to the best of our collective ability. Then there's the selling price, deal structure, and the negotiation that goes along with it. Furthermore, there's no guarantee of a successful outcome. So at a minimum, you need to be prepared to go back home and continue to operate your business to the best of your ability if a deal doesn't get done. What this looks like and how it plays out from a graphical standpoint is that there starts a phase of discovery in the beginning, where typically a company such as Tusk, that might be your partner in going to market, spends a lot of time meeting with the founders to learn the history of the business in terms of what's made the business successful over that period of time. You establish a valuation for the business by analyzing all financial and operational aspects and determining an adjusted EBITDA multiple relative to market comparables. You develop the story behind the business of what's made it successful up to this point and try to amplify the opportunity of the business under a new owner's hands, meaning you try to position the business in the best possible light for the buyer, the greatest amount of upside. The marketed sale process is one where we court as many potential buyers as possible, be they financial buyers or strategic buyers, to solicit interest from qualified buyers, and then have them sign non-disclosure agreements to learn all the details of the business. After an NDA is signed, you go through a due diligence phase, and then the negotiation takes place to outline and define the terms of the actual transaction document. I'm going to dig more closely into the last two pieces, the due diligence and the negotiation phase. It plays out something like this. An initial offer is made from a buyer after performing preliminary financial analysis. Then a letter of intent, or LOI, is sent to the seller. A letter of intent is a non-binding legal document that grants the private equity group or established DSO some level of exclusivity over a period of time to pursue additional due diligence. As they're going through that process, three things typically take place examining the business overall. There's typically what's known as a quality of earnings report, or Q of E. A quality of earnings report is an analysis of the business at a financial level to trace where all the company's revenues, profits, and expenses reside. They're trying to poke holes ultimately in the EBITDA of the business or validate where the true profitability of that business by an objective third party. Objective third party in this case is typically a CPA firm. Next, there's an operational assessment that gets done. An operational assessment is something where some of the operators of the acquiring company go in and assess the operations of the business to be acquired. Operations are everything from the way software is operating and how you bill third-party payers, down to the level of the way the equipment in your individual operatories is maintained and how it's performing from a reliability standpoint. The prospective buyer wants to take apart all possible aspects of the business from a standpoint of identifying potential future costs that they may have to incur in order to upgrade or replace existing equipment or technology infrastructure. Finally, there's a clinical review where a chief clinical officer of the acquiring company is going to go in and perform a glorified chart audit, essentially, of your dental practice. They want to see how everything is documented, see how treatment plans are proposed and established in the patient's record. They're going to look into aspects of billing as well, and certainly all of the clinical notes and compliance protocols that go along with everything like that. Assuming that the quality of earnings report, the operational assessment, and the clinical review all check out accordingly, they're all going to sign off on it, and the deal will move forward for funding by the potential acquiring company. The potential acquiring company has a process that they have to go through to get approval for all the deals that get done for funding. Assuming that the funds are okayed and approved, then it goes to the legal documents stage, and closing dates are confirmed at that point. So let's take a quick look in terms of who the potential buy side is from a financial and a strategic standpoint. If you want to sell your business, who's going to be the entity to buy it? So we're going to define buyers of DSOs and small groups in two main categories. The first are strategic buyers. Strategic buyers are established operating companies that are already in the space. Could be a competitor or an established DSO. They might be unrelated to your company, but looking for an opportunity to enter into your state or something like that. Their goal is to identify companies that are a complementary fit and make acquisitions to grow market share, integrating the acquired company into their existing business, obviously. Strategic buyers in the dental practice space are companies like Heartland Dental, North American Dental Group, etc. Financial buyers, on the other hand, are typically private equity groups or private equity funds. These groups are in the business of making investments in companies with the intent of growing them, operating them, scaling them, improving them from a financial standpoint, and then ultimately exiting at some point in time and realizing a return on their investment for their shareholders. Examples of financial buyers of dental practices include Blue Sea Capital, Berkshire Partners, among many, many others in the space. So let's define the buyers at a bit more macro level. In the U.S. overall, U.S. economy overall, strategic buyers typically pay more than financial buyers. There was a study in 2016 from Pepperdine University that revealed that strategic buyers over 50% of the time will pay double digits more than financial buyers. 10% of the time, that premium is over 50%, which is borne out in this particular graph from the Pepperdine study. This is not, however, what we're seeing in the dental space, which begs the question as to why. Right now, we're seeing financial buyers, private equity groups, paying a lot more than strategics, meaning established DSOs, in dentistry. And there's several market conditions for that. The number of private equity groups has grown to all-time highs over the last several years. As a matter of fact, in 2015, there were over 4,300 private equity groups constituted. Maybe not all of those, obviously, were in dental, but the proliferation of private equity groups over about a 10-year period has been substantial. But it's not just a number of groups that are in the market space. It really comes back to the amount of available funds and capital to be invested in different sectors by private equity groups that's the driver of all of this. The dental market conditions themselves are that the business of dentistry is still in the early stages of consolidation. And in this stage, there are many more financial than strategic buyers in the market space. In short, financial buyers see high returns and great opportunity for scale as they ride the wave of consolidation to produce enviable returns for their investors. And they want to see it at the table, willing to pay for that, and they're willing to pay a premium. Competition for quality assets is incredibly fierce right now. So let's talk about multiples and comparables, our industry against a number of others. Multiples are based on something called EBITDA. You've heard me talk about this in several other presentations we've done if you've been on all of our 3 preceding webinars. EBITDA is a proxy for operating cash flow, irrespective of capital structure, assets, state taxes, and things. And it stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is the metric that all transactions are based upon. And the best way I can tell you to rationalize it is that it's normalized operating cash flow in a business. So how does the business of dentistry compare to some other segments of the overall economy? This is that same study from Pepperdine University in 2016, and they took a look at all different sectors of the economy based on what multiples were averaging in those different sectors and according to EBITDA level. I'll give you some parameters here. So they base this on EBITDA, and they break it down by businesses that are basically 0 to $1 million in EBITDA, $1 to $5 million, and $5 to $10 million. That's the majority of what we see in the dental space. The U.S. economy overall, for businesses of $1 million or less in EBITDA, averaged about 4.6 times as an EBITDA multiple. You can see as you go up slightly in terms of EBITDA amount, those numbers tick up in the U.S. economy overall. Dentistry is part of the healthcare segment, healthcare and biotech specifically. It's interesting to note that in 2016, healthcare companies of $1 million or less in EBITDA traded at roughly 3 times. Those businesses that were $1 to $5 million showed about a 6x multiple, and those that were 5 to 10 times showed about a 7 times multiple. Well, when you compare that against our industry, dental group practices and DSOs, what does it look like? Current industry multiples for group dental practices in the $1 million and less EBITDA category are about 4 to 6 times. Those that are 1 to 5 million in EBITDA are somewhere around 6 to 8 times. And those that are 5 to 10 probably trade in the 8 to 10 times or even more than that. That's several turns greater than the segment we find ourselves in of healthcare overall. And it's also several turns greater than the US economy overall. This is another way of graphically representing that it's a great time to be in the business of dentistry, specifically in group practice. This chart also corroborates some of what I was just indicating in terms of some of the multiples that have been paid over the last handful of years when group practices or regional DSOs were acquired by private equity companies. And 2 trades specifically to note were the Linden Capital acquisition of Gentle Dental back in October of 12 that changed hands at about a 9.8 times multiple compared against the Deca Dental deal that was a historical 18 times multiple. That seems to be the high water mark that everybody points to, but there's there's a story behind the story, and depending on who you ask on the Deca Dental deal, it might have been an 18 times historical multiple, but more like a little bit over 10 to 11 times on a forward-looking multiple. An unbelievably well-run business and a great story for both the people who built Deca as well as Blue Sea that acquired Deca, and that business continues to perform at an incredibly high level even to this day. So financial buyers will pay a premium for a platform business. Let's refresh our memory in case you don't remember the prior webinar, or in case you weren't able to actually see it, on what an actual platform business is. A platform business is one that's categorized by scalable infrastructure with professional management, meaning a strong management team, savvy operators, and a track record of success. It's a business that's built with centralized infrastructure to facilitate acquisitions or de novo startups as part of a growth strategy. And some of the centralized services that it most likely has are things like a call center or centralized accounting services or centralized insurance processing. What is not a platform business is what we refer to as a collection of dots on a map. This might be a group dental practice with no centralized infrastructure, no economies of scale, and they could, in fact, all be running disparate technology systems across all the different locations. So we hear gaudy numbers being thrown around the 19th hole or at dental society meetings these days from people saying, I sold my business for $50 million. But have you ever asked yourself, what does that really mean? I mean, if they sold their business for $50 million, did somebody give them $50 million cash to put in their bank account and they went off and bought an island in the Caribbean? Or were there details behind the transaction? Nothing is ever as it seems. And I caution you to proceed with a healthy level of skepticism about when someone says how much their business sold for. The devil's in the details typically. In fact, details typically matter more than multiples. So let's take a look at deal structure from a foundational level. Deal structure is made up of several different components. There's obviously the sale price, like we just mentioned. There's the EBITDA multiple, but there are different aspects known as cash at close, that is cash in your back pocket or bank account, like I just mentioned. There's an earnout, which can be broken out over some number of years with some dollar amount tied to it, as well as a growth percentage tied to it. There's occasionally something called an equity roll, which is the ability to take some of the proceeds of the transaction that you realize as the seller and roll it into the equity of the parent company to go along for the ride before the overall business might be sold again. at a subsequent point in time and realize an even greater outcome. That equity role takes into account an amount and an expected rate of return. But there are also employment details. When you sell your business, you're probably going to be expected to stay on board with the parent company for some period of time. So it's worth it to consider things like compensation rate, the overall benefits package that's being offered, if there are equity opportunities in the parent company, and what that employment contract and non-compete looks like from a time and distance standpoint. And finally, there are aspects of the buyer themselves that's worthy of a consideration. Are they a financial or a strategic buyer? And do they have experience in the dental industry specifically? So let's illustrate this by walking and talking through a possible transaction to see what this might look like. In this situation, we're going to show an example of a business that has $5 million in EBITDA. We've gotten two offers on the table from buyer A and buyer B. Buyer A is offering us $50 million and buyer B is offering us $45 million. That's a difference in $5 million. Buyer A's multiple is a 10 times multiple, whereas buyer B's is a 9 times multiple. Now, if you stop right there, you would say, surely buyer A is the buyer of choice. That's the better offer to go with, right? Well, maybe, maybe not. Let's unpack the deal a little bit more, and let's see how the deal is structured. As an example, in this situation, buyer A is going to offer you $25 million cash at close. Buyer B is going to offer you a little bit over $31 million cash at close. Remember, I said cash at close is the money in your bank account. It's the money in your back pocket. It's the bird in the hand. Buyer A is going to structure the other 50% of their transaction in an earnout over some period of time. Buyer B is only going to structure 20% of their transaction in an earnout, and they're going to give you an opportunity to roll 10% of the proceeds of the transaction into the parent company in an equity roll. Both earnouts in this situation are going to take place over 4 years' time. The cash value each year in those earnouts is as follows. Buyer A's has more of theirs heavily weighted to an earnout of over $6 million a year, whereas buyer B is a little bit over $2 million a year. Now, assuming you meet the growth expectations each year and you ring the bell from years 1 through 4, you receive the proceeds of the earnout. After year 1, buyer B is still ahead by about $2.5 million in terms of proceeds. But over years 2, 3, and 4, buyer A takes the lead in terms of total amount of earnout realized and total reward of the overall transaction. As a matter of fact, if you hit 100% of the earnout goal in each of these situations, in each of these offers, buyer A would be the preferred buyer to the tune of $9.5 million. So clearly, they're the buyer of choice, right? Well, remember, I said that there was an equity roll option for buyer B. Buyer A didn't offer one. Buyer B said, we'll let you defer 10% or $4.5 million of the proceeds of the sale into the parent company. Our expected hold time is about 4 years, and we expect our return over that period of time to be 300%. If you'd like to put 10% of the proceeds of the transaction into the parent company and go along for the ride to take a second bite of the apple, so to speak, you could earn a substantial reward for that. In this situation, if the business continues to perform, the way you expect it will and the way they expect it will, that $4.5 million, it's the proceeds that are reinvested in the equity of the parent company that yield a 300% return, are valued at $13.5 million. Now, when we look at the total value after 4 years' time of the two offers, buyer B comes out ahead to the tune of $4 million based on the appreciation of the equity roll. So clearly, buyer B is the preferred buyer, right? Well, by now you should know that there's still more details to come. As I said before, you're going to end up working for the company that you sell your business to for some period of time. So let's see what it's like to be an employee there. Buyer A offers a compensation rate of 33% of collections, whereas buyer B is at 28%. Buyer A is not going to pick up any of the lab costs, whereas buyer B is going to cover 100% of those costs. You're going to sign an employment agreement either way. Buyer A's is going to be for 3 years and 3 miles around the practice where you're working, whereas buyer B's is 2 years and 10 miles. Buyer B is going to pick up 100% of your health benefits, whereas buyer A is not going to pick up any. Both are going to cover both are going to offer some retirement option, and buyer B is actually going to have a match to the retirement plan. Buyer B is also going to cover your malpractice insurance, and they're going to cover $5,000 worth of continuing ed for you every year, whereas buyer A is only going to cover $1,000. Buyer A allows you to take an ownership stake in the PC that you're working in, but not in the mothership DSO, whereas buyer B is the exact opposite. Buyer A, however, does offer you the ability to earn equity into the business without having to put cash in. These are some of the nuances and the complicated employment structure options that are entailed in a lot of these purchase agreements that's worth considering based on what your future expectations are after you sell your business. Finally, it's worth considering who the buyers themselves are. Buyer A is a private equity company, just like buyer B is. No difference there. However, buyer A has healthcare experience and they have dental experience specifically. Buyer B has neither of the above. So if you're considering offers from two different competing companies, and one of them has a high equity roll stake but has no dental experience, that might be worth a point of consideration as you evaluate the transaction opportunities. So it brings us back to what we originally started out with in terms of what's the best deal. The best deal is one that balances your short-term and long-term expectations. In the short term, it's worth it to consider things like your personal time frame in terms of the go-forward look with the business. Cash at close is obviously cash in your back pocket that's yours to spend as you see fit. And there are employment details like compensation and benefits, the way we went through them, that are worthy of consideration in the short term. The longer term considerations are things like the characteristics of the buyers themselves, the earnout structure, the value of that earnout, and the time frame involved, along with the equity roll opportunity and the increase in enterprise value. But ultimately, the best deal is one that balances your short-term and your long-term expectations. And if we're able to do that, hopefully we find the right buyer for your business and the right employer for you going forward in the new entity. And with that, I'll take a pause and open it up for some questions and hopefully a couple of answers.
Okay, let's take a Take a couple of quick looks here at some of the questions as they're rolling in, and I'll try to take them from the top. So the first question comes in, says, when you were speaking about the market share of various dental segments, what did you base the market share on? Was it the number of practices, revenue, et cetera? Good question. And I should be clear when I'm presenting that slide, because I probably get that question a pretty decent amount. So here's the answer. When we talk about the percentages of the market, meaning that private practice, your single location practice makes up 75% of the market, your middle market makes up 13% of the market, and so on and so forth. That market share number is based on number of locations. The difference at the bottom of the slide, if you'll recall, I talked about compounded annual growth rate, which is CAGR. And I talked about the velocity of the way that those businesses were growing within that segment. And that's based on revenue. So the market share numbers, meaning like what the pie looks like, is based on location count. And then the compounded annual growth rate is based more on the actual revenue numbers within those practices. And I think that's an important point to differentiate, because it really substantiates how quickly the middle market, your 2 to 25 location groups, are actually growing as it relates to same-store sales and revenue growth. Not just the fact that they're picking up dots on a map, but that those dots are growing at a faster rate than your traditional solo location dental practices. Very, very good question. The second question is comes from a person that sold their practice to a corporation several years ago. They still own the building, and the corporation's renting from them. They want to sell the building, but the corporation's not interested in the real estate. Is there a market for the building? That's really on a case-by-case basis in terms of the local markets. Most DSOs, not all, but most of any size, be they enterprise level or smaller markets, aren't interested in real estate. So if you do own the real estate in your practice and you sell to a group, you'll probably end up with like a 10-year lease, 15-year lease to rent back to that corporation. If that's 100% cash flow positive, meaning you no longer have a mortgage on the building or anything, then that's a steady stream of income with really no cost attached to it. On the other hand, if you do probably have a mortgage left on it, or still paying it down, and the length of that is longer than what the rent term is, you might want to think about selling that earlier on. I'm not a financial planner, obviously, but the opportunity to sell a building that has a longer lease tied to it is probably better than at the tail end of it. The next question is current performance of the group or potential success more important when selling? Again, this is a little bit case by case. I'll give you some color on it, though. Businesses are valued based on historical performance, but they're all bought based on future performance. So this question kind of relates more toward the potential buyer and how much of a premium are they willing to place on the business that they're buying. And the premium is typically going to be tied toward more of a potential success component, meaning the upside to the business. When we take a group to market, we're always trying to tell the story of the business from a future context, meaning the upside to the buyer. There's additional revenue opportunities. There are unequipped operatories that could be immediately equipped to gain greater revenue. There's further cost synergies and consolidations, those types of things. And when you get the right business that's for sale in the right local market with positive demographic changes and everything along those lines, then a potential buyer is willing to pay more for it because they can rationalize the premium relative to their expertise and current business structure a lot more readily. So, I think that's kind of splitting hairs, but it's a context of both sides of that question. The next question is, do you have a different strategy if targeting a private equity group versus a DSO as a buyer? I can answer this question two ways as well. Is there a difference in the process of targeting a private equity group or a DSO buyer? Not too terribly much. You're always trying to paint the business in the best possible light for any acquirer, like I mentioned earlier, and that process doesn't really change too dramatically relative to whether it's an established enterprise level DSO or a private equity group. If you're asking the question from a growth strategy, like if you're building a business and you want to scale it from a handful of locations up to some number, do you build it differently if you're targeting a private equity group to be the buyer of the business at the end of that period, or if you're targeting a DSO, then yes, I think you could build it to a specific suitor. An established DSO, certainly an enterprise one, is already going to have that scalable infrastructure, business systems, back-end office, all of that type of considerations already in place, and they run things their way. Whereas a private equity group very well could be looking for a smaller group with the established infrastructure that is a cornerstone piece to an overall strategy. So if you're considering scaling your group and you're evaluating whether or not you want to invest resources, meaning money, in a centralized call center and scalable infrastructure, that can be dependent upon what your exit time frame is, and if you are trying to court a certain type of buyer, private equity group versus an established DSO. When starting the selling process, are you obligated to let the various practices know your intention? I think that means practices like within the envelope of your existing business, meaning your current practices that you own or manage. No, you don't, but you need to let your shareholders know. So, I mean, that's kind of splitting hairs. You don't want to let everyone know in the business, but the certain stakeholders in the business, certainly those that are going to be voting on things like change of control and defining your non-negotiables and things like that, do need to know about that process, and it's a worthy consideration based on how the decision making gets done at the corporate level. Is there a sweet spot for selling price, a point where you see a decline in successful sales? I'm not too sure I understand the full context of this question, but I'll go ahead and say that there's not, I don't know that I'd call it a real sweet spot for a selling price from a decline standpoint. But what I'll say is that, when we talk about valuation multiples and things like that, it's probably better for you to think about it in terms of a stair-step graph versus like a linear trajectory, if that makes sense as I'm verbalizing this. But so, businesses, group practices that hit $1 million in EBITDA are valued at some range, depending on a lot of different factors. Those that hit, those that go from $1 to $3 million, there's usually a a turn more in terms of potential EBITDA multiple, and those that go from 3 to north of 4 or even 5 see a turn or possibly 2 increase in terms of EBITDA multiple. So I think instead of it being like a point where we see a decline in successful sales, it's more like the stair step up in terms of multiples that acquirers are willing to pay. It goes with it stands to reason that you know, the bigger businesses get in terms of EBITDA is usually the larger they are in terms of number of locations, and certainly they also have more established scalable infrastructure. The bigger the business gets, and usually acquirers are willing to pay some semblance of a premium there. You know, I think the other thing to consider too is one of the questions we often get is about the market, and are we at the peak of valuation, and where do we see kind of that trajectory continuing to go? And obviously I don't have a crystal ball, but I think from the people that we talk to most often that are either in the industry or looking to get into the industry, the common train of thought is that we don't talk about the heights of valuation being a peak and an immediate decline. So it doesn't look like, you know, at the top of a triangle where today we're on the upside and tomorrow we're on the downside. I think it stands to reason that we're probably at a high water mark, but we may be at a plateau where valuation multiples may hold out for some, you know, indefinite period of time, not going up much, but also not receding too much either. And as it relates to valuation, you know, the cost of capital continues to rise, and I think the Fed is earmarked to increase federal funds rate by 4 times this calendar year. So as the cost of borrowing continues to go up, I think that'll start to put a bit of a cold cloth a bit on valuations, and you might see some of them start to recede in the years to come. But I think we're at a high water mark, and there the top of the trend seems to be more of a plateau versus upside and immediate downside. Last thing I'll say as we close out tonight is, will you get a copy of the slide deck? And yes, we typically compile all the attendees over the next couple of days, and I'll try to get the deck out to everybody who attended this webinar. So you ought to see that hopefully by the end of the week, or if at the latest, the first part of next week. So as we're wrapping things up here, I don't think there are any further questions, but I'll just kind of close it out and say that I really appreciate everybody being on tonight's webinar, and for those that made all 4 of them in this series, I hope you found them to be very informative and educational, and hopefully help give you a little bit of guidance as it relates to building and operating your group. And certainly want to thank the good people at Pelton and Crane for sponsoring this and making it happen. This has been fun for us to do, and again, I hope that all the attendees got a lot out of it as well. Please remember to click the Continue to Evaluation button below the video window to receive your CE credits. And with that, I'll sign off and say good night. Thank you very much.